Welcome, everyone. I'm Angelo Robles, and welcome to Family Office TV and Family Office Masterclass. Very excited about today's interview, a return guest, and I believe on my Family Office TV platform, which is really only a couple of months old, the first return guest. So that says a lot about our special guest. I've known him for many years as a wonderful investor and much more a deeper thinker. It's very excited to have him on, and I think the topic is very timely to a lot of the things that we've been talking about this week at Family Office TV. And really, it's a timely topic for any investor, family office, or really person who's interested in entrepreneurship, investing, and understanding that it's a unique time at the moment. So we titled it US Comparative, really to the world, a little more focus on US and BRICS, because that's been the dynamic that has been playing out from a lot of different perspectives lately. You could all follow me on my social media platforms and go to angelorobles.com to learn more about the work that we do, specifically in Family Office Masterclass, and the work that we do with single family offices. Our special guest today features Ram Ahluwalia, CEO and co-founder of Lumida. Ram, welcome back to the show.
Thanks for having me, Angelo. It's always a pleasure. Great to see you.
Thank you. Let's get right to it. Is the US in decline?
I never thought that a non-consensus position would be to say US is still the leader in the world, and I have to defend that position. No, the US has challenges. The US is a bit overweight. It got a bit sloppy. The debt to GDP ratio is too high. We need to improve upon things like public education and rationalizing spending and addressing issues like entitlements. But no, the US is not in decline. If you think about what are the KPIs for national strength, what are they? One would be economic strength. Second would be technological strength. Third would be military. Fourth would be demographics. And then fifth would be a kind of catch-all for other forms of strength, including biotechnology, culture of entrepreneurship, institutions, rule of law, and property rights. On all of those dimensions, the United States is the leader. In technology, the number one hub globally for technology is still the United States. In terms of military, it's still the United States. The number one Navy in the world is the United States. The number two Navy in the world is the United States Air Force. So no, the US is not in decline.
Okay. I mean, you say some things a little bit in passing as if they're a little bit inconsequential. A $33 trillion deficit, growing political bifurcation. I can make the argument, not the greatest political leadership in the country, although maybe compared to the world, I'm not so sure. But I think that relative to its position, if I look at the Bretton Woods many years ago, coming off the gold standard in 71, the advent of the Cold War, the ending of the Cold War, the late 80s to 90s, and some of the things you're mentioning about US hegemony, if I could use that word, at nothing else. Yes, is it probably still the leader, but is it the same percentage of leadership, broadly speaking, versus the rest of the world that it might have had 10 or 20 years ago? Is it closing the gap, and is competition good?
Great point. So first off, on political cohesion, you're right. That's an issue. It's also called democracy. It's not perfect. And yes, we need more leadership. And that's a challenge. And of course, you saw then the brinksmanship around the debt ceiling. You see that today in terms of what's happening around Congress and finding a Speaker of the House and so forth. That's an issue, but it's not a primary consideration when you're thinking about what marks national greatness. The debt to GDP is an issue as well. And within that, it's really entitlements, especially around 10 to 12 years from now, where that starts to become felt. But we have time to address that, and that takes political leadership. It's not a pressing concern. You brought up Bretton Woods and you brought up other periods in American history, which are actually far more challenging than now. Think about the civil rights era. Think about the challenging political dynamics during that era versus now, or the Civil War, far more challenging times than you had now, or when the United States went off the gold standard, or had 1970s inflation. We haven't had unemployment this low since the 60s. So yes, there are issues, but American global dominance is not in decline, and international competition is healthy. Competition brings out the best in individuals. It brings out the best in sports teams and athletes and communities, and also at the country level too. Where capital is rewarded is where capital will flow, and the United States is still the least dirty shirt in the laundry basket.
What are the KPIs of national greatness? And perhaps for the younger ones and those that may not understand the acronym, what is a KPI?
Yeah, so KPI is a key performance indicator. I use this term when you manage a business, and I'll list a few. So one is technology leadership. So great civilizations have a leadership position around technology. If you look at throughout history, in the development of the phalanx or the legion or gunpowder, that conferred some competitive advantage or the discovery of new metals on the civilization. Second is military dominance. Third is the health and the quality of the banking system. Fourth would be demographics. And do you have a demographic pyramid? The rest of the world is aging, and China especially has serious issues around the demographic pyramid because of the one-child policy. They can't recover from that quickly. And so does Japan, and Europe is aging. Other attributes that you want to look for are a culture of entrepreneurship. So the best place to build a business is still the United States. We attract the finest entrepreneurs globally. And the United States has the institutions, capability, and policy in place to assimilate people of a broad range of backgrounds. Sergey Brin was born in Russia, and he's moved to the United States. Meanwhile, China is criticizing Jack Ma, who could have been a hero for the population. They have a very different set of values. Other KPIs include capital flows. Where is capital flowing? To the United States. Where is capital growing and rewarded? It's the United States. What's the best performing market globally over the last 10, 20, 30 years? It's the United States. Where are the finest educational institutions? Now, there are quite a few global world-class institutions, of course, but rivals to the United States send their kids to Stanford, to Columbia, to Harvard, to Yale. It's the United States. Advanced technical education, biotechnology, 99% of new biotechnology IP also originates in the United States. So those are the KPIs for national greatness.
Let's dive a little bit deeper into several of them. I don't know if we're going to be able to touch all because we have a lot to talk about today and making it what I know is going to be a very engaging dialogue for the community. So one of them, you mentioned the educational system. We've been talking about that for decades and decades and decades. And I understand, is it a challenge? And this is both a education and immigration question lumped into one. Are we educating the finest intellectual minds, talents in the world, and then encouraging them to go back and take what they learned here, and I get it, what they paid for in American school, back to their home country? Where's the advantage to us? Don't we want them, as in the past, to be motivated to build companies here, to have commitment, to have families here, to grow here in the United States?
It's a great question. I say, first off, I think the balance of trade on talent benefits the United States. The United States benefits from the brain drain. We import talent on net. And to the extent we train them here and they head back home, that also has a global benefit too. American values are noble values, rule of law, institutions, how court systems work. Other countries model off the United States and how we govern. And I think there's a benefit there as well. One of the interesting things about education, like the United States, a lot of issues, and public education is one of them. If you look at how the United States scores on, say, STEM, science, technology, engineering, and math, we're never in a leadership position. I would bet that China far and away exceeds the United States on that dimension and public education, other attributes. But it turns out that that's not a primary consideration for national greatness. It's quite interesting. Now, certainly at the elite education levels, the United States excels in there. What matters is leadership. And American leadership, American management, American capital markets, entrepreneurship, which are premised on trust and shared values and communities. The ability to make an investment in someone else and make a bet on them on good faith is something that's unique. I would say that the United States excels in. It's not unique to the United States, but we have multiple angel markets from Silicon Valley to New York City to Miami to Dallas to Boston to Austin and so forth. That's a sign of that.
We'll move off this part of the subject in a second, but I think I'd be remiss, and I want to be careful how I spew my verbiage. So I'm going to be a little bit on the, by Angelo standards, a little bit overly politically correct. I hear what you're saying. We have some of the greatest universities on earth, many of them that go back well over 100 years. And there's some amazing talent, both in country and out of country, that come here and are educated. And again, like you said, even those that leave may still have a sense of, wow, that was a great experience during my time in America. And it helps to counteract what they might have been told about only the negative. I completely get it. But it does seem a little bit, looking from afar in, that advantage to some degree is eroding as I look around the world. But on a deeper level, it appears to be very skewed to one side of the aisle. And I would say the same thing if it was overly skewed to the other side. That's not good either. So do we have a system here of tenured professors and the general thematic premise, including at some of the amazing universities that you noted, and we're seeing some of this in a little bit of political internal strife and bifurcation happening now at some of these universities, that is it indoctrinating, quote unquote, young talented people, both born here and born abroad, to kind of one specific way of thinking?
It's a great question. Yeah, no, it's a phenomenal question. And I should clarify a bit more what I mean by higher education. The deeper idea behind US's leadership is that we have one of the most specialized economies in the world, and we have leadership positions in that specialization. And that then links back to, among other things, not just entrepreneurship, but also the university level. When you think about the leadership of Caltech and MIT and Stanford Engineering. So that's really what I'm referring to there. On the humanities, I think humanities have an important role to play. I went to a undergrad liberal arts college called Columbia, studied philosophy and economics and a dash of physics there. And I think that's where your question and comment is coming from. And you're right. I found myself consistently in the non-consensus camp, on university in various classes. And there is diversity of thinking, I would say, although, you can get punished for having an out of consensus view on a college campus. We see that today. I spoke with a professor who teaches at Columbia yesterday night, and they are aware of the consequences of taking a non-consensus view, let's say around, the issues surrounding Israel and Palestine. No one wants protest. No one wants to be canceled. No one wants a letter writing campaign to get them kicked out of school. And, one of the great virtues of the United States is our tolerance and our ability to assimilate other cultures and have a public square that's enshrined in the First Amendment and free speech. And I think we can do better there. And I'm dismayed by, what I'm seeing. When I was in college, we would have these late night debates, as I'm sure you did, Angelo, and others did, to 2 a.m. to 3 a.m. in the morning with people of all different political persuasions. I remember having conversations with Marxists, bona fide Marxists. And I was defending, free markets. And I'm glad that I could have that conversation. I'm glad that they were able to have that conversation. We both learned and benefited from it.
Yes, maybe like a little bit of a follow-up to that. We all have a perspective when we're young that's a little bit skewed to our upbringing and our perception of the world. Then I wouldn't say reality, but as time goes by, we're allowed to adapt and we're allowed to change. I had one perspective when I was younger, and after, again, living decade after decade, interacting, you tend to adapt in terms of your opinion, which is one of the reasons why. And again, I know we're kind of skirting around certain issues, and I think
you don't have to.
relative to what we're talking about, that's fine. I disagree with a well-known hedge fund manager that's been very active on Twitter. You know what? Initially, I was tempted to agree with him, but I changed my mind and we
Bill
adapt.
Ackman?
I don't think that we should hold against 18 to 22-year-olds the perspective of how they feel at the moment for the rest of their life and their career, that they be banned. I don't like that, because we have perspectives that we learn and we adapt. We're more empathetic than simply cold, bluntly, it's either left or right or white or black. I think that's not the proper way to think. And if we are more agreeing on the other side of the fence, we're not going to win them over with that sort of attitude. We're going to win them over by listening, hearing their grievances, letting them know where we think they're wrong, and where there could be sort of a middle ground that we could meet, as opposed to, you're a terrible person, I don't care if you're young, you're never going to work in this country again. I don't like that.
Yeah. Yeah, look, I think the two most important things we can teach are critical reasoning and the value of fellow humanity and kindness, and goes back to empathy for, the other person. And yeah, when you put a label on someone, it's easier to dehumanize them. It's easier to attribute ideas to them and intentions that aren't fair. So we have to do a better job. Yeah, people's views evolve. My views have evolved, and there's more that we don't know than we do know. And I believe that a
That's one of
principle.
my sayings.
It's true. I mean, it's what the more. Many philosophers have talked about this, right? Those who teach don't know; those who know don't teach, right? Like, having humility is very important, and I think having a principles-based approach to navigating the world and one's relationship with others is critical. For example, how we approach policy. Like, I believe information is local. It's in one another's relationships and communities and specialized trades and knowledge, and that's why we have a presumption of freedom, while there are certain constraints and standards around how we interact with one another, not harming someone else, respecting property rights, and so forth.
Well, actually, on that front, in changing gears a little bit, but staying on that core question that I asked you about what makes the USA great. And again, we probably can't go through all seven. We have a lot to talk about, but I'm going to pick on a couple of more. One of them
Sure.
is, and you just hinted at it, kind of rule of law. We have a democracy in this country. We have a rule of law. We have a structure from the Supreme Court on down. And that's all very, very important. Now we're going to kind of kill two birds with one stone again. Yes, I want you to comment about the value and importance of independence and rule of law, but I do want to remind the audience that contractual law and rule of law means nothing if it can't be enforced. And that relates a little bit to a sense of a democracy, of structure, and it does relate a lot to military. And I don't mean to make it an overly, again, bifurcated conversation, but, let's completely dismantle the military. All is fine. We could put the 800, whatever it is, billion to other use. There won't be a country left that would able to enforce the law and rule of contract, title and real estate, structures, whatever you name it to be. There needs to be a sense of enforcement, for lack of a better word, and consequences and a deterrent. Are we spending too much money on military? That's not necessarily for me to answer, but I kind of know this. The day that it's needed, and really, really needed, it's probably never enough money. Why don't I stop there? I'm giving you a pretty tough 1-2 punch, but I want to hear your answer.
Well, good fences make good neighbors. And that's true not just nationally, but internationally. So trade routes are protected by American Navy, for example, around the Taiwan Straits. So yes, international laws are also enforced by nations, and domestically that's true too. If we didn't have law enforcement, then each of us privately would need to invest in our own law enforcement, which would be incredibly costly. It would be a tax on each of us that would limit our ability to invest and grow the productive enterprise. So we have these shared resources. They're public goods. We call them law enforcement. And yeah, it's a critical function to play. And when those are stressed, bad things happen, because the resourcing to law enforcement is designed to address day-to-day issues It's not designed to address surge capacity. Similarly with hospitals and many other functions actually in the economy. There's a bit of a buffer, but there's a presumption of stability. There's a presumption that you're staying within the normal distribution. Same thing for banks, right? A bank can't tolerate a high standard deviation run on the bank. Banks have to model out what their expected liquidity is. Obviously, they've got to apply regulation. And so that matters. And so norms matter, institutions matter, expectations matter.
Of course, it matters greatly. And yeah, that's, again, these are complicated issues that we're bringing up.
Yes.
From my perspective, it's representing, I've traveled the world. I consider myself a global citizen. I do agree that generally Americans tend to be a little bit too siloed and a little bit too bifurcated. And having the opportunity to travel, it actually not only makes me appreciate other cultures and people and be more respectful of them and listening and sometimes adapting my opinion, it actually makes me more appreciative for what we do have here in the United States. There's things that will probably go around the world in a couple of different continents and kind of where there may be advantages and disadvantages in a second. So my focus in terms of what I do and have been doing for decades, yes, it is focused on the family office community, primarily the single family office community. And I think that's far more than strictly an investing or a philanthropic conversation, but that's a part of it. It's deeper dialogues that are macro, that are economic, that are global, that are geopolitical, and they are sometimes uncomfortable, but they absolutely relate. At the end of the day, really the greatest threat to the family of wealth is their own family. It's a lack of capacity and capability, which is competency. And to some degree, we could argue the softer things and dynamics of empathy and the ability to travel and kind of understand humanity in the world, I think is very, very important. And really the number one thing, in my opinion, for families and family offices to sustain. You did mention kind of capital markets and banking. And I would think the US would have a significant advantage when I think of all the advantages we have there. But in looking at some of the statistics, some of the largest 10 banks in the world on a pretty equal number to the US are based in China.
Yes.
Are our advantages eroding? And what could we do to play more nimbly on the global stage?
It's a great point. So of the top 10 banks, 4 are American, 4 are in China, 1 is in India, and 1 is in the United Kingdom. The banking sector is near and dear to my heart, and it is a major driver of national strength. So the US is still the number 1 banking system in the world. If you are a wealthy family, you want a bank account in one or both of the United States and Switzerland. In Switzerland, it's UBS. By the way, the Swiss government they've submitted to US bank regulatory standards, such as the Bank Secrecy Act, for instance. So, and in Switzerland, the only game in town is UBS. In the United States, there's a diverse competitive market of 4,000 banks. And those banks have niche lending strategies. They service customers in different ways. They specialize in different ways. And that's one of the advantages that the United States has over many other countries. For example, Canada's got a half a dozen banks. China has a lot of issues right now. You see that with Evergrande. You see that with declining property prices. You see that with increased debt defaults. China is ahead on consumer finance markets, right? Meaning, when I went to China back in 2015, what I noticed is that no one's using cash. It's a cashless society. If you try to pay in local currency, the yuan, people look at you funny because you're wasting their time. It's not convenient. And they have a digital economy. You know, on Tencent has an app called WeChat. And on WeChat, people exchange money digitally. They give gifts to one another. They're called red envelopes. They have things like NFTs and avatars. So they have a more modern digital banking system. At the same time, though, there are weaknesses to their approach. India also has a very modern cashless world that they're leading towards. I mean, there's no privacy, and we have the privilege of privacy in the United States. So the US is the leading banking platform in the world. it's ours to lose, I think we'll make the right decisions. And one way to advance that is around digital assets, blockchain technology, right? You deposit your assets at a bank because fundamentally the bank provides security for your custodied assets. Think of it like your safe deposit box. Cryptography via encryption can provide greater security over digital asset than a physical asset at a bank. And so if we can embrace and modernize the banking system, including by enabling competition from technology firms to enter, right? Every big tech company would like to own a bank. Tesla would like to finance cars. Google would like to be able to compete with Visa, MasterCard. They have millions of merchants and consumers on both sides. Amazon owns Whole Foods. Amazon should have bank branches at Whole Foods, and they'll deliver a great consumer app. Walmart could expand financial inclusion to those that most need financial services competitively. So there are a lot of things we can do to strengthen the banking system. Absolutely.
A very interesting points. Why don't we dive a little further into at least some of those that you brought up? You actually piqued my interest. I remember thinking about this 20 years ago with what you just said. Like, how come we don't let loose some incredible American companies that are more modern and tech savvy, AKA in Silicon Valley and Greater Washington, the Microsofts, et cetera, the Apples of the world, into banking? And I've kind of went a little bit back and forth. Are they already too dominating? Is this an issue with antitrust? But would it give us a competitive advantage? Would it take our technology in a little bit of an antiquated model comparative to other parts of the world up to another level? You spoke more positively about the developments as that's happening. Could you give us a little bit of a balance of what you think could be the positive, but what also could be a little bit of the negative as well?
A great question. Two themes here. One is regulatory capture, and then centralization versus competition.
Mhm.
So JP Morgan, when it started, was a water company. It was not a bank. Now it's a bank. So there are regulations, namely the Bank Holding Company Act, and certain provisions which prevent the commingling of commerce and banking. And some of the reasoning behind that is that you didn't want the bank to finance its own operations, but you can regulate that. And by the way, it's already regulated today. It's called Section 23A, affiliate lending restrictions. And other countries in the world don't have the same policy posture as the United States. So the point is, you can open up competition, right? Decades ago, there were 30,000 plus banks in the United States. Now we have 4,000, and they're becoming increasingly consolidated, increasingly concentrated. The bigger are getting bigger, and the middle is getting hollowed out. You see that with the regional banks, and community banks are getting acquired. So I believe we should enable not just big technology companies, but others that meet the standards of safety and soundness to own and operate a bank. You know, there's a reason why Silicon Valley Bank could not get bailed out by the venture capital firms or private equity. It's because it is illegal for a non-bank to have a controlling interest in a bank. That's why. And if you want to own a bank, you have to have at least 10 groups, because if one group owns more than 9.99%, then they are subject to additional scrutiny and requirements, and may have to attend deep monthly board meetings, or all sorts of challenges to owning a bank. And those regulations need to change. Now, your second point, Angelo, is around, are we helping technology firms get larger? This is a great point. There are a few sub points here. One is that the big tech firms are struggling to grow earnings. We're seeing that. These are geriatric tech companies. They need to find new avenues of growth. Banking is one avenue in their defense, and it'll help consumers. These tech firms are very well capitalized. Apple has $90 billion in cash. That's multiples of what the losses incurred to the FDIC insurance fund, which totals about $120 billion, by the way, right? So the big tech companies can serve as what's called a source of strength for the banking system, as opposed to impacting the taxpayer. However, what we really need is competition. We need more banks from different perspectives, not just the big tech companies. Angela, you and I should open up a bank focused on
Exactly.
or niche customer segments, right? There are a lot of neobanks out there trying to do banking, but they can't own a bank. And those neobanks should be subject to stringent standards of safety and soundness, because a bank fundamentally has 10 turns of leverage. And Therefore, they have to be highly regulated and well managed, and you need management teams that know what they're doing, and they have to be highly controlled. They play an important role in the extension of credit in a national economy.
Yes, so we're going to circle back to banking a little bit later and even some initiatives that you're doing that I think are very intriguing. Maybe one final question relative to banks. As we're recording this, it's October of 2023. Earlier this year in the bank in America, the US, we had several banks, some of pretty brand name stature, kind of go under. We have the interest rates rising drastically, commercial lenders with a lot of capital out there. I could argue bank capital and long-term treasuries, which may not be the best move. I could paint from an outsider looking in what appears to be a little bit of an ugly picture. Where am I maybe, I wouldn't say embellishing, but not getting quite right? And how could I paint a more rosy future for how we could resolve some of these challenges?
Right. Well, no two banks are created equal, and different segments of the banking sector have different challenges. The segment that has the most challenges ahead of them are the regional banks, because their funding costs are go up. They've got to pay more out to depositors to maintain that deposit. And their net interest margin, the difference between the return on the asset and the cost of funding, meaning what they pay out to depositors, is shrinking and may even be flipping for certain banks. The regional banks are in a world of pain. Community banks, by and large, are okay. They have sticky deposits. They have local relationships. They can underwrite and finance commercial real estate, which is primarily what regional banks and community banks especially do, by the way. Unlike the large banks, where they issue credit cards and they finance corporate and they finance payments and so forth, right? So the big banks are getting bigger. And if you run a large bank, you can poach a regional bank team and start originating more loans with all of your excess deposits that you're borrowing at 0%. So the big banks are in a great spot. And during the banking crisis, I wrote this on Twitter, we bought JP Morgan, we bought UBS, we bought Morgan Stanley. But you have to discern and focus on banks that have a good position, deposit funding bank, excess capital, a competitive advantage. We like asset management. We like wealth management. That's not much risk taking. It's not like Credit Suisse, where they are taking real risk with that activity. There are hold to maturity losses, as you pointed out. Our Bank of America's got over $100 billion in that. But they can hold that to maturity by pledging that to the Federal Reserve. I expect the Federal Reserve will renew the Bank Term Funding Program, which will expire in March. And if they do that, then they can hold to maturity. There are consequences, however, right? The consequences are, if you're an investor and you're saying, gee, should I own this asset called Bank of America? You're going to value this on a mark-to-market basis. You're not going to give them credit for hold to maturity. You're going to look at tangible book value. And Bank of America has suffered that, meaning their stock price has not performed the same way JP Morgan has as a consequence of that decision-making.
And we'll move a little bit to when we were mentioning kind of the US versus or comparative to the world. And you brought it up early on, and that would be effectively a culture of entrepreneurship, a culture that kind of accepts the fact that a little bit cowboy, libertarian, go for it. You fail, you'll be forgiven. You fail again, we'll probably forgive you again. That coupled with what you may define as an innovation society, both here and the world coming here. And it's not just Silicon Valley, although that's an important part. I could look at Austin, LA, even little communities like Boulder, bigger ones like Miami and New York. The US is pretty thriving from that perspective. That's not to say that other parts of the world in the Far East, in Berlin, Germany, and others don't have, in the Middle East, don't have pockets of some intriguing what they're doing in terms of their entrepreneurship and the growing effectively innovation in the markets. So looking at kind of the US versus everyone else, we still have a lead. How do we potentially maintain that? And where are we losing ground? And I'm assuming it's primarily to developments in Asia and maybe people being educated here, like I noted earlier, going back and bringing their brightness, their energy, their enthusiasm, and building, quote unquote, locally to their homeland.
Right. Well, you're right. You're right on. Look, there's increased entrepreneurial investing in venture markets in South Korea, United Kingdom, Singapore. China has more venture capital investment in semiconductors than the United States
Yes.
on a dollars and numbers basis and a deals basis too. Singapore is making a bid to be the next capital market, Dubai. So international competition is real. And entrepreneurship brings together three things: discovery, innovation, and trust, right? And those are qualities you want in a nation. I've got to make a bet on an entrepreneur that they've got a unique insight in a customer, and they're going through the dark forest to discover, to learn how to improve upon something, address a pain point, deliver value. That's discovery. Find a better way to do it, innovation. Lead and build that. And trust is the bedrock for that. And that's where America excels, bringing all those qualities together. Right. Now, where are the opportunity areas is what this turns on. And what's required to maintain that? It's good policy, right? For example, what are some of the top 2 or 3 areas to focus on? One, the banking sector needs competition. We've talked about that. We got to enable digital assets regulation so that entrepreneurs can build here and create responsible competition and enable the free flow of money. For example, why is it that a merchant, the corner bodega, has to pay 3% to the triopoly of American Express, the MasterCards, Visa, card issuers of the world, when you can send money frictionlessly, instantly on blockchain without that transaction cost? And by the way, the net profit margin of that retailer is about 1%. So it's a material impact. And those are small businesses, those are families that are generating income from those opportunities. So one is around banking and fintech policy more generally, enabling competition. The other is the healthcare sector. So, the healthcare sector is full of inefficiency, and also we need to rethink policies there to encourage more competition. I had to get a tooth pulled. I called up my dentist. He looked at it and he took an x-ray and he said, I got to refer you out to this other dentist. He's actually pulled a tooth out. So dentist number 2 pulls a tooth out and he refers me to dentist number 3 to go get a crown. And so I called up dentist number 1 after all this was done, after being feed to death by all these dentists and all the time costs. Right? I said, well, how many years of training did you go through? He said, 7 years. So 7 years. Why did you refer me to dentist number 2? Didn't you have the skill to do that? So, well, I could have done that function, but I don't know how to stitch. I said, but you can learn how to stitch. Why don't you have those skills? So, we need to rethink education, training, the licensing models around how this works, enable open data while protecting privacy so we can get more discovery and innovation. A HIPAA regulation makes it difficult to generate new ideas to treat patients, but there's a lot of opportunity. There's some health AI funds that we're looking at. I think healthcare venture is promising, interesting. Biotechnology is very interesting. There's a lot of innovation happening there. There's new modalities that are coming online. In the past, it's always about the molecule, like Lipitor or Viagra or whatever it might be, statins. And right now we have new modalities coming online, like mRNA and other techniques and treatments. So I'm excited about the future ahead. But to answer your question, that's what we need. We need policy that enables more competition and innovation, so that we can lower costs and improve care, for our people.
And well, it took 4 months on Family Office TV, Ron, but someone, I guess, finally mentioned Viagra. So what can I say? Hey, it's a very, very, very successful drug. I wonder why. It made that company, now it's in, I guess, generic form, a hell of a lot of money.
Right. Now we have Ozempic coming online. That's the next one. Everyone's going to know Ozempic, right? It's a metaphor for the United States. The United States is not in decline, but nationally we're overweight. We've got excess debt to GDP. We've got to tighten things up. We've got to get back in shape. We've got to sharpen things. Yes, we've got to improve the political cohesion as well. We got to focus on what matters. We have to address issues, prioritize them, make good decisions, but that's within our control.
And then sometimes you do have to look at comparative to the rest of the world. No, we're not going to do a super deep dive into each continent, but I'm Just thinking from my own personal experiences, I mean, who doesn't love Europe? So many amazing countries there, history and culture, beautiful architecture,
Yeah.
probably better food, broadly speaking.
Absolutely better
Come
food.
on, I'm
Yeah.
half Italian, so going to Italy was an amazing experience. Wonderful people and culture from Romania to
Oh,
Poland to sometimes Sweden. Uh, but you probably get a little bit of the direction that I'm going. It does feel sometimes a little dated, a little bit not quite as energetic as what I notice in the US. And there's something about the US where we're just accepting of go for it. You don't
yeah.
have to work for the man or the government. And by the way, like I said earlier, if you fail, we'll kind of forget about it 30 days later and just try again. Where in other cultures, I notice like even within the family, like, oh, like you tried something, it didn't work out. Just
Right.
go to work inside the government now or get a boring job.
Right.
Like we still, for now, I don't know if it's going to last forever. We still seem to have that spirit. And even in Asia, where things are happening incredibly well, there's a little bit sometimes of the stigma of you tried and you failed and that, shame on the family. Like that's just ridiculous. But
Right.
maybe that plays to our advantage. So with your experiences being what I would call a global citizen as well, and maybe you want to pick on
Totally.
one continent and not look at all of them.
Yeah.
Uh, these appear to be advantages that go back to the culture of entrepreneurship and innovation that we still have here, that other parts of the world are probably playing catch up, but they kind of have a way to go.
Yeah, a few things there. So one is, within Europe, you look at Dublin, there's an entrepreneurial culture. Portugal,
Yes.
Berlin, Eastern Europe, Kiev. So there are hubs of innovation. Helsinki, where Linus
Sure.
Torvalds, the founder of Linux. So there are innovation hubs, but you're right, it's not broad based, and part of it I think turns on status. In Europe, you have aristocracy, and the family you came from in certain parts still matters, and you have deep, long intergenerational histories that go back long periods of time. And America fundamentally was a nation that was formed through immigration. By the way, immigration is the ultimate form of entrepreneurship. You're saying, I'm making a decision to leave my homeland, my family, my neighbors, to move to a new land, learn a new language, acquire a new set of skills. There are people that have moved to the United States that were professionally licensed as physicians or other skilled trades and are driving Ubers and Lyfts. Nothing against Ubers and Lyfts, but anyone can do that. It doesn't require licensing. So that, I think, it plays a part of that. The American culture doesn't turn on aristocracy. We root for the underdog.
Mm-hmm.
We also have a focus on athletics and like the NCAA and healthy competition as sport. I think that plays a role in this as well.
Yes, that all does. And by the way, I'm going to have a follow up to that in a second, but a little bit of just an announcement at the moment. This is what I hope you're all enjoying is a wonderful discussion, again, in an industry, family office industry, that generally does not have these kind of discussions. We hope aspects of it and more to come are going to apply to you as a family office, from internally with the family, from better decision making from the family office to investing, whatever it may be. I know it's going to provide value, but I do want to note, again, this is for entertainment and educational purposes. At the end of the day, it's opinion. And you're going to have to make your own decisions, however you look at the world, however you decide to allocate. This is our opinions at this moment. New information comes in, like playing poker. It may change a day later, a week later. Henceforth, you may watch this video some point in the future. There may be some nuggets here or there, but the information that we're now basing our decisions and how we adapt may be totally different. So at the end of the day, especially from an investing perspective, you have to understand your own liquidity needs, your time horizon, what your goals are. And at the end of the day, you have to do your own diligence and you have to make your own decisions, period. That onus and that burden, if you want to call it, is on you. At the end of the day, like when I interviewed Michael Saylor, the billionaire, what he learned at MIT, the best thing was think for yourself. So I leave that onto you to all, quote unquote, think for yourself. Okay, here's another one where, relative to what you said, I want to be careful how I phrase this. It's not always easy for me, but when I do my travels to Europe, and some of the issues that I see going on now, I do see that it does look and feel different to me. When I went to, say, Scandinavia 10 years ago versus more recently to France and other countries, we pride ourselves in the US, as much as some of us don't want to admit it, to the fact that we are a country of immigrants from a variety of different countries, including on effectively both sides for my heritage and my family. And I do agree that we need to be the land of opportunity. I do agree that you can't just assume because someone doesn't have a certain IQ or is not going to school that they're not going to be value contributors to society. And you don't know the children that they have, who they're going to become, that could become the next incredible person. And a reminder, Americans, Elon Musk was not born in this country. We are fortunate that he wanted to start his endeavors in this country. Very, very fortunate. Nonetheless, I do admit there was a certain level of being assimilated into the US mindset, into the US culture. Okay, maybe from one generation we maintain the old language, like on my mother's Italian heritage side, but that kind of dissipates probably simply after one generation. I don't know if I'm seeing that happening now in aspects of Europe that are a little concerning to me, and possibly what could happen here. So that relates a little bit to immigration, even here in this country, let alone the world. And I admit I'm a little bit more kind of on the fence now. I'm not as open as I might have looked at it even a year ago. I've gotten a little bit more closed-minded, if you want to call it that, although others in the audience would say you've woken up and gotten smart. And I'm not 100% sure that I'm right either way. I don't know if there's going to be a great answer or a right answer for this. Again, this is definitely opinion more than fact, but I would love to hear your opinion.
Right. So the constraint on US growth is human capital. It's not financial capital. We have plenty of that. We have large markets. And as you pointed out, Elon Musk came from South Africa. Sergey Brin immigrated from Russia. The CEO of Google came from India. And we need more human capital. We need more human capital at all levels. We can't get enough of it. If you want to combat inflation, you need human capital on the service economy side as well. So I think that United States still has a competitive advantage around that. The ability of the United States to assimilate people as well is another competitive advantage. We have the ability to do that, and it goes back to the separation of church and state. These were very far-sighted principles that the founding fathers identified and enshrined in the Constitution that continues to serve us well today. And other countries struggle with this. I remain optimistic on our ability to navigate those challenges because we have a good foundation.
Well, those definitely are challenges. And yes, our political leaders have a very, very hard job. And I don't necessarily, I have more questions than I certainly have answers to. And I think it will get interesting. But you're correct. If I can look at it from the other perspective, most Western countries are aging rapidly. China's aging rapidly. Yeah. The US is not as bad from that perspective as other parts of the world. And that could be part of that is due to immigration of younger people that are, let's go with the word, hungry and want to work. Now, part of that could also relate to a conversation that we're not going to get into today, but the concept of population, of children, of the concept of marriage and having kids. And the younger ones now appear to not be quite as down from that perspective as they might have been in past generations. But that issue is amplified in other parts of the world, or most other parts of the world relative to here. Now, could I make the argument with what you said that might be offset with the advent of robotics and AI and the impact that could make effectively on the economy and the GDP moving forward?
It's a profound question. So a few things there. One is we don't want to be complacent. I'm not saying of course we have to address these issues. We got to address these issues. However, we're going to see these other countries which have more severe and pressing issues confront them first. And we're going to see the consequence if they don't confront them. Does Japan's yield curve blow out? That's going to create urgency locally to address these issues. Although I hope we don't wait for something to break before we do. The second point is to your point, Angelo, this is a very subtle point, but we don't know the kids of the immigrants too, right? And it goes back to the earlier part of the conversation. The impact of leadership in the United States is highly magnified. It turns out you don't need everyone to have 99th percentile scores on STEM tests. You need enough of them to go to Caltech and MIT and build businesses and hire the right people and deepen specialization. That's the magic of the American economy. And I'm reminded of this old bet between Julian Simon and Paul Ehrlich. I'm sure you know what that is too. Back then, a couple of decades ago, they made I think it was a Trading Places $1 wager, and there was a debate around scarcity. And Paul Ehrlich said, look, I'm going to build a basket of these 6 commodities, and I bet you that the real cost of these will be higher 10 years from now. And Julian Simon took the other bet, and Julian Simon was right. And the point he was making is that the ultimate resource is human capital. It's people, right? Look at oil. Oil, if it was on your land in the 18th century, it was a cost. You didn't want to have it. And then it became valuable. Or you could say that for other commodities like lithium or uranium. It'd be radioactive, literally die. Now we have ways to treat that and becomes a source of energy. But the key is human capital. It's human innovation. And one idea from an Einstein and Elon Musk can have a transformative impact that benefits the broad population. So I believe that more human capital, we need more of it, and that's what also encourages national greatness. I think you had a third point though.
Yes, and actually that third point, to give a little bit of a hook to the audience, is going to relate to a recent Mark Andreessen quote. Why don't we hold that off to the final stage, which will be about 20 minutes in. So for the audience, Andreessen, who's an iconic figure in VC, made a pretty startling quote. Whether I agree or not, well, we'll find out, but that's not that important. It's Ram's deeper dive into that subject that will relate to productivity and AI and some of the good and some of the bad. So I promise that's upcoming and relatively shortly. Let's talk a little bit. I promised I would come back to this about banking, about finance, and you're, actually in consideration of something now. So why is owning a bank potentially a good move to make here in the US? Now, there's unique things here in the US too. Besides the states, we also have territories. There's certain advantages in one of our territories, which relates to one of my other cultural heritages, and that would be Puerto Rico. So talk a little bit about the spirit of entrepreneurship, advancements in banking, what you see as an opportunity, and potentially how, again, a territory like Puerto Rico and certain advantages there could all kind of play in this together.
Well, banks are a Warren Buffett business, and banks help communities grow. They represent discovery, which you talked about. They represent trust. They represent investing in a community. They put savings to work. So they have a vital function. They're also a Warren Buffett business, right? So if you read Snowflake, which is one of Buffett's biographies, before he invested in Geico, he bought 3 banks. And even in the modern era, not now, but even a few years ago, he owned Bank of America, Goldman Sachs, Ally Bank, American Express, and so on. So it's a Buffett business. And why is it a Buffett business? Well, one, you have an opportunity to build a brand and a sticky relationship with the end customer. 2, banks can reprice their assets and liabilities with respect to inflation. 3, banks are protected from competition. And we talked about that a bit earlier. The barrier to entry to the banking system is high. 4th, banks have advantages from the federal government in a lender of last resort called the Federal Reserve and access to FDIC insurance, which makes their business model viable and helps to protect against things like bank runs. 6, if a bank can make a loan for 3%, which is a very attractive loan, you can't get a mortgage now for 8%. And the average bank has 10 turns of leverage, meaning the average bank is capitalized with 10% of equity. That's called core equity tier 1 capital. That's the regulatory metric. Then your return on equity, also another key Buffett metric, on a 3% return on asset is around 30%. I'm simplifying. excluding fixed charges and all the rest. And so they can compound value quickly. So I looked at JP Morgan's earnings. Again, I wrote about this on Twitter. Every quarter, I look at their consumer bank with awe and reverence. Their consumer bank has a return on equity of 40%. This is the largest bank in the world. Think about that. What was return on equity? Return on equity is the net income you generate for a given amount of capital. And they're able to generate that return on equity at scale. And so if you can get your hands on a bank, you should do that. Now, JP Morgan's expensive in the public market. So the idea would be to acquire a bank that's privately held, that's in good standing with the regulators, and then reposition. You mentioned Puerto Rico. Well, why Puerto Rico? You can't get a jumbo mortgage in Puerto Rico. A jumbo mortgage is a mortgage that you can't originate and sell to Fannie Mae and Freddie Mac because the dollar value of the mortgage exceeds their lending criteria. And there's a lot of wealth in Puerto Rico, in the Dorado area. So we have clients there and they're like, I can't get a mortgage. They're not financing, they're funding in cash. Or they have a non-bank private credit lender that's charging a double-digit interest rate to build a house or get a mortgage. So that would be one of the areas to focus. That's something we think about pretty closely. If someone in the audience is focused on this, wants to own a chunk of a bank, shoot me a note. I think it's a very intriguing opportunity.
So do I. I find banking for a variety of purposes, not strictly only from an investing perspective. It gets deeper than that. And my audience knows the work I do on sovereign risk and disaster preparedness. I believe the ultra wealthy should also have considerations for offshore ownership of banks. That could include even an iconic country like Switzerland. You're probably buying a very antiquated private bank that is losing money and has antiquated technology. Why do that? It's not necessarily from the investing perspective, although in theory, if you're very good at operating companies and financial services companies and you properly capitalize, it may be. But there's deeper purposes than that. I would say being close to kind of what's happening around the world, including the Bank of International Settlements, keeping your ear to the grindstone. You could argue it could be your own custodian, depending on a variety of different factors and how it's structured. So to me, the concept of, and it applies to captive and reinsurance companies as well. And I admit now we're probably playing into multi-billionaire territory for true direct investments in terms of what I'm stating, but onshore and offshore, I think would be something that would be intriguing.
There's a lot there. First Citizens National is a bank that's outperformed the S&P 500 for decades. So banks can compound the book value quickly. They're very attractive opportunities. And look at First Republic. So I played a small role in the deal team at Merrill Lynch when I was an analyst 20 years ago. And Merrill Lynch acquired First Republic. Then we had to sell it during the financial crisis to create liquidity. We sold it to a private equity company called General Atlantic in New York.
Yeah,
huge private equity company. They took it public at about $1 billion market cap. And 10 years later, First Republic was worth $40 billion, a 40x return in public markets for a bank. By the way, if you had bought other banks in the public markets in the wake of the financial crisis after the market caps were decimated, you could throw a dart at a mega cap bank, Citibank, JP Morgan, Bank of America. Those would have done 7 to 10x in public markets. Now, again, there's a capital imbalance there in the wake of the financial crisis. These banks were hated. It was not consensus. Therefore, they're cheap. That creates opportunity. But the headline message there is that banks can create significant value. They've got unique advantages. They're very special businesses, and they're worth investing and owning.
Yes, I too am also intrigued by that. And by the way, audience, where's your questions? Come on, this is an opportunity. So we probably still got about 20 or so minutes left to the bottom of the hour, but feel free to ask your questions. I think it'll be a valuable opportunity. Let's turn our attention to make a lot of the investors and single family offices who are investing centric, which is a lot of them, happy, although I think we touched upon a fair number of things that at least interplay into that. But in terms of investment themes, we'll maybe pick out, or I'll allow you to pick out a couple. Let's save AI till we get the Andreessen quote, then we'll loop that in at the end. But before I ask that, related to that investment theme question, and call me boring, Call me boring. It's okay. Although, come on, with this color sports jacket, how boring could I be? But am I wrong to say that if I'm going to be tactical, if I appreciate liquidity and geopolitically, there's crazy things happening, I don't know how the markets are going to react tomorrow, a month from now, a year from now. Ooh, 30-day T-bills are paying like 5%. That looks pretty darn attractive to me. Where am I wrong?
Yeah. When T-bills are the most attractive, it's also usually historically the time when you ought to be buying equities. In 1982, T-bills were also really attractive. In October of last year, credit spreads are quite wide. And at the same time, that was the bottom of the equity market too. On the geopolitical front, there's no consistent relationship between global conflict and asset prices. I did a tweet about this. I have a chart. I show historical conflict. I show the 1 month, 3 month, 1 year forward returns. And being fearful on account of that is a mistake. So, I think you have to be thoughtful and you have to be discriminating in terms of your exposures, particularly in public equities. For example, Netflix is growing at a 6% year-over-year earnings growth rate. It's got a P/E ratio of 40. That makes no sense. There are 125 companies that are publicly listed that have earnings growth rates of over 25%. And you're paying a multiple for quality and earnings growth. I don't want to pay a 40x multiple for 6% earnings growth. And there are a lot of these legacy big tech geriatric companies that are so large that size the enemy of returns. And it's hard for them to keep growing. Not all of them, but some of them. I talked about Apple back in June. Apple's declined in price. The PE multiples come down. Apple had a year-over-year revenue decline. Nike has declines in their year-over-year sales. And there's a broader theme also about these legacy brands that are in decline as well. Look at Disney. Disney is struggling to generate revenue to keep up even with the level of inflation. So you have to be thoughtful about your exposures. I think active management is back. Higher real interest rates change everything. Boring is good. Venture capital outlook, probably not that great. The last time we spoke, Angelo, I mentioned the nuclear renaissance hypothesis. I would say since that time, that piece has been up double digits. Wow. Multiple different ways. Yeah, since that time, especially the last 2 months. So,
tell us more about that. Like, one, if you had to give a simple 1-minute thesis, and then are there things in the public markets that investors are doing? I actually shared a model portfolio of 7 or 8 names on how to approach that. There's the uranium miners like Cameco. There's the infrastructure providers, including like Rolls-Royce, folks that manufacture the turbines and all the rest. But that's one. But here's a new focus area, I would suggest, a new idea. Okay.
And it's not private credit. I do think there's some good, really exceptional opportunities there, but I think that's well known, people talking about that, right? If you're not looking at private credit, you should. But again, be thoughtful about the structure, the asset protection, where you are on the capital stack, all the rest. So semiconductors, and this brings us back to AI. There's a jump ball taking place across big tech. What do I mean by that? You have Google, you have Amazon, you've got Microsoft, you've got Meta that are competing to own the customer relationship. They want to be the primary port of call every day, every hour when you're on your mobile phone. And AI is causing CapEx investment across all these big technology firms because the stakes are too high. If they don't grow earnings, then they're going to get PE multiple compression.
For sure.
They have extraordinary businesses, and that's at risk. Apple's theory sucks. Amazon sucks. AI is a jump ball that's creating this competition. And so they're investing tens of billions in the silicon layer. So when you approach AI, high level, you can bet on the application layer. That's the OpenAI's. OpenAI is an $86 billion valuation now on $1 billion in revenue. I think it's too much money. Not going to pay for that. Or you can bet on the silicon layer. And the thing we know for sure is that in the world of AI, there's a distinction to make between being a CapEx payer, which is the application layer. That takes a lot of capital, a lot of money, which the big tech companies have and governments have to spend, or being a CapEx receiver. And I believe the opportunity is betting on the CapEx receivers. You're betting on cash in hand. And people need semiconductors yesterday, and a lot of ways to approach that category within the silicon layer. It's a deep value chain within that.
What's next with biotechnology?
Biotech's very exciting. I want to wait a few more months, but within biotechnology, you have, first off, the biotech index at 10-year lows, number one. So it's non-consensus. It's been down 2 years in a row. I don't believe we've seen a scenario where it's down 3 years in a row. Number three, you've got scores of biotech companies trading below net cash assets. Now, they're also negative free cash flow. That's why they're trading below net cash assets. But there's value there, is the main point. And biotech is really like investing in these lottery tickets. You have companies that have some IP, and if they can get through phase 1, phase 2, and get a good TAM and product market fit, there's an opportunity there. So I believe the opportunity to invest in biotech is significant, right? The big pharma companies, they're experiencing an unusual cluster of IP patent cliffs in the back half of this decade. And they're going to need to acquire biotechnology companies. That's what they do. That's what big pharma does. They acquire biotechnology, integrate it, and then deliver it. So I think biotech's very exciting. And I think the way to approach biotechnology is through a specialized hedge fund. I'm not a big fan of hedge funds, by the way. I don't think most earn their keep after fees. But you want to find hedge funds that have the databases. They've looked at all the clinical trials. It's organized by mortality or disease risk factor, et cetera. And they have the probability tables on the likelihood of, say, an Alzheimer's drug advancing to phase 1, phase 2, commercial impact, and what that means. And they have real edge and they have real skill. And we like biotech, certain biotech long, short hedge fund managers. We're happy to pay fees because the risk-adjusted returns are compelling. They make money on the short side, they make money on the long side, and it's not correlated to the S&P. So I like that thesis.
Very interesting. And a little bit out of left field, Ram, but something that you know a thing or two about.
That's why it's interesting. When no one's talking about it, that's what makes it interesting. When everyone's talking about something, then it's more and more consensus.
And that brings me to a bit of a next subject before we do a final dive into AI and wrap it up. Something that you're definitely fluid in, lost a little bit of luster. I was a little bit of from my perspective, a figurehead in the crypto and Bitcoin type community. That interviewing for an hour and 40 minutes, Michael Saylor, was very intriguing. And the family office audiences, I would say, are a little skeptical. We don't have time to get into the kind of off the grid aspect and more of the sovereign citizen. And those may be very important aspects. Lord knows things that I'm intrigued by in the community, strictly from, I guess you could say, an investing perspective. What is your current thesis on Bitcoin?
I'm constructive. Digital assets have been the best performing asset class year to date. It's been the most hated rally.
Yes.
And FTX and the demise of Genesis in November 16th marked the bottom. So the bottom's in. Now, what I'd like to see is DOJ take some action on Binance, not because of anything that's Binance. I just want that news headline out of the way and behind us. But there are stories that people are ignoring that are positive, right? ETFs are coming. Chair Gensler has lost. That's important. Bitcoin is emerging as a macro asset. It trades like that today. If the dollar's up, Bitcoin's down, vice versa. There's still more to do. And I think how you approach it matters. I wouldn't touch Bitcoin miners, for example. The halving in Bitcoin means that Bitcoin miners will lose half of their revenue. That's not a great business model. If every 4 years half your revenue goes away, and they're also debt financed. So there, you want to articulate your position well. I like the discount to NAV closed-end fund plays because I think there's a pull to par dynamic when ETFs are approved. I think there are good opportunities there, both around Bitcoin and also Ethereum. But you do want to stick to quality. I don't think playing in the altcoin area is wise at this current point. That opportunity I expect will emerge maybe in 6 months, but you have to reassess and see where we are.
And to make my old guard single family offices that only care about investing. And that's fine. I love you guys too. And we could go pretty deep into that stuff. What would be, let me rephrase the question I was going to ask, because you're ear to the grindstone with other single family offices, wonderful allocating families, some of them more rigorous and institutional than ever before. Usually going to be $1 billion and up, but could be a variety. Doesn't necessarily need to be that scale. Why don't I phrase it as what are some thematic things? And if you wanted to be more specific, great, that you're seeing. And by the way, some of them in biotech, in Bitcoin, in banking, you might have touched on. But if you had to summarize, what are maybe 2 or 3 things that you're seeing? What would that be?
Yeah. So the area that has the best risk-adjusted return, by that I mean return per unit of risk or return divided by drawdown, right?
I want to hear it.
Risk-adjusted return, which is how one should approach investing, by the way, is distressed commercial real estate. There is pain in multifamily and commercial real estate. The regional banks and community banks are experiencing a drawdown in the deposit system, about 8%. They cannot refinance their borrowers. And you have developers that took out construction financing even just 15 months ago at a very low rate. And now it's 500 basis points higher. And there's less cash flow due to remote work. So I am seeing transactions, and I'm trying to converse with other family offices. Here's a live transaction for you. In Milwaukee, Class A property, commercial real estate building, family office bought for a 12% cap rate. Cap rate said net operating income divided the purchase price of the asset. The seller was Brookfield.
Wow.
Brookfield. 12% cap rate. So they're sitting on a 2x multiple because in a normal market, when there's not a capital imbalance, which is what's driving this opportunity today. In a normal market, that cap rate would have a premium to a comparable duration treasury. There'd be a liquidity compensation. And so they're sitting on 2x. But even better opportunities than that. Here's another one. I love trade examples and stories like this, but here's another one. There's a shopping mall that a top 10 bank acquired. They wanted to reposition it into multifamily because shopping malls presumably are going away. They invested $40 million in CapEx. They acquired the asset for $90 million. And they can't get the permits approved. They can't reposition this thing. Okay. They're selling this, and the buyer, who's going to be under contract imminently, is buying this for 40 cents on the dollar. They're keeping the malls, and they're lining up tenants. They're going to sell the parking lot to Costco. So that's great. These are the opportunities that are happening out there. Here's another. I'll give you a third one. There's a lot of opportunities like there. There's another developer, or distressed commercial real estate investor, I should say, that's buying a note a loan from a bank at about 45 cents on the dollar. Now the bank, they issued a loan at a loan to value to developer of 35%. Meaning, let's say there's a property that's got $100 million market value. They extended a loan of $35 million, and they're in a senior position. So they're protected. They have a buffer of $65 million against losses. So the bank is not trying to optimize for price. They're optimized for certainty of closing. And these are small community banks that don't have access to auction systems or investment banks like you do with New York City commercial office or big trophy assets.
Exactly.
So you have this distressed buyer who's bidding on that note for 45, 48 cents on the dollar. Once they have possession of that note, then they'll foreclose on the asset because that borrower isn't paying their bills, and they'll back into the asset. That's clever. So that's what we're seeing in the market. And this will accelerate after the year end, by the way, because after year end, what's going to happen is you're going to have another type of NAV audit processes, statements that have to go to investors. That's going to force the crystallization and call it quasi mark to market of these assets, and that'll force more selling. And Brookfield doesn't care. These are old funds. They want to wash their hands. They want to move on. They're raising new mega funds to bet on the same opportunity, which I find ironic.
Wow. I mean, those were a couple of great insights. We could probably do a whole show around that. And by the way, doing this because some of you, Angelo's only about structures and best practices and taxation and geopolitical and broadly economics and Mr. Family Office from a deeper, high level perspective. All true. I love investing. Of course, investing is an incredibly important part of many people becoming wealthy in a family office, maintaining wealth in there now. It's a very important part. And when I do it, I don't do it lightly with crap. We have great guests on like we're having today. And although it may not have been as long as I would have liked from the investing perspective, we go deep. So those of you that are saying that Angelo does not do investing anymore, you're completely wrong. But again, a disclaimer, your situation could be totally different. This is educational. This is entertaining. Times change as the weeks and months go on. We don't know when you're going to watch this video. Your situation could be totally different. And also, we could be wrong. You just don't know. When you invest, you could lose money. So at the end of the day, make your own decision, make your own thoughts, and move forward with your own diligence and decision-making process. The burden for that, as it should be, is on you. On the final note, I'm going to pull up kind of a quasi-quote as we go into a little bit of AI. Mark Andreessen, the iconic Mark Andreessen, calls slowing down AI tantamount, I wouldn't quite use this word, but I guess it's what he said, murder. He also criticizes the concepts such as sustainability and social responsibility. Do you agree?
Let me make the defense of Mark Andreessen here. So when you have policy, for example, around the appropriate levels of benzene peroxide in the air, you're doing mortality analysis. When you calibrate the appropriate level of, say, pollutants, there's a statistical excess death. And there's an incremental one death if you have this level or you save a life at another level. I think that's the right framework to think about what he's saying there. This has to, like seatbelts. If you don't have seatbelts, you have more deaths. You can quantify statistical deaths. So what Mark is saying is that AI is going to unlock a better way to live longer, to have better health, and I think that's absolutely right. We are seeing AI LLMs focus on protein folding or identifying new genomics where they share in the revenue and the upside. They don't charge anything upfront. They say, we're just going to split the revenue with you on the IP production value of what we're developing. Now, murder is a loaded word. Murder means malintent. It's not the same as killing. It's not the same as a more neutral term like death. But I believe we do need to accelerate AI to unlock the value. But technology cuts both ways like a sword. I use the metaphor of Prometheus bringing fire from the Greek gods down to the people, and he was cursed for that. And fire creates warmth. It creates light. It improves the quality of living. We can cook with it, but it also can burn. And AI is the same way. And that's true for all the technology we have in our life. You can get in a car accident. You can overdose on a pharmaceutical drug. So we have to approach it thoughtfully. But by and large, we should be grateful that we live in an era that we live in today. The best time to be alive is, if not today, is tomorrow. So I'm optimistic. I'm excited about what AI presents, and it may be what saves us from all these issues, Andrew, that began the call with debt to GDP. If you have more production in your economy through AI and robots, then that production translates into GDP. If we got a debt to GDP problem, you can grow the denominator, then AI might be a way to bail out our current situation.
And when you look at some of the public markets for investors to invest in AI, NVIDIA, Microsoft, Alphabet, so there are definitely opportunities. Yeah. There's obviously private. We can make a whole show about this, but maybe in wrapping up in 1 minute, investment opportunity in AI, what would you say about that?
Within the so-called Magnificent Seven, I don't think many of them are terribly magnificent. I'd say Google is probably one of the best risk-adjusted returns if you look at valuation and their bets on AI, they're going to have their own GPU chips that developing with Broadcom, so they're not reliant on NVIDIA. That's one. NVIDIA, I think, has a good story, but they're going to face increased competition. They're posting good growth numbers, and their PE multiple is compressing rapidly. I'm long Google, I'm long NVIDIA, but I think there are better moves in both of them. And over the last 6 months, I've been doing a deep dive in semiconductors. Actually, in an interview with Dylan Patel, who leads semi analysis of Substack, he has 5 people on his team. This is all they study. And I'm focused again on the silicon layer. So Broadcom is quite interesting, 200 billion market cap company. They're enabling the Googles and the Amazons of the world to build their own GPU tech stacks. They don't rely on NVIDIA. That's another way to approach it. ASML is another one. ASML develops infrastructure for foundries to do lithography. They beat revenue, they beat earnings. They announced yesterday. I think they're even better moves than those two, though, by the way. If you're in semis, you know these names, right?
Of course.
So you have to keep going down the value chain, and you find some other ideas. I think KLAC is interesting. There are also certain component suppliers in the semiconductor space as well. I have a post, I believe, on Twitter where I shared a model portfolio of different semiconductor names. We have a newsletter. I definitely put it in the newsletter for sure. But you can take a look at that on the semiconductor side. I think there's some very good opportunity. I think in the next 10 years, there will be 10x opportunities in semiconductors. We saw the 10x already in the Amazons and the Googles of the world the last 10 years. These companies have market caps that are so large. Apple's 2.7 trillion.
Right.
Our GDP is 20 trillion. Apple's not going to be worth $27 trillion 10 years from now. That's not going to happen. So, and it's very rare. I have not found the scenario in history. I'd love to hear a counter-argument to this, where the best investment of the last 10 years was the best investment of the next 10 years. It does not happen. So
actually, you do remind me of an interesting question to maybe end on. I think I've done something like this before. If you look at the top 10 companies, the largest companies in the world, in 10-year blocks going back, whatever, maybe to the 80s, 4 decades, there is one company that has been there the whole time, and they move around in terms of what rank they would be.
Let me guess before you tell me, though. Go ahead.
What would that company be?
Merck, Eli Lilly?
Not Merck. Eli Lilly now, I believe, is at the last spot, but that company would be a tech company. It'd be Microsoft.
Yes.
If I had a crystal ball, let's not even wait 10 years. 5 years from now, what kind of shakeup are we going to see in the top 10?
Right. It's a phenomenal question. Now, Microsoft, of course, after the dot-com era, had a lost decade. And a new leadership came in and repositioned Microsoft into a SaaS business, and they bet on the cloud. So they made 2 strategic bets, and Microsoft's one of the finest businesses in the world. But the enterprise value to sales makes it one of the most expensive businesses in the world as well. So I'm not a big fan of Microsoft from an investor perspective. We want wonderful businesses at fair prices. Everyone knows Microsoft. It's consensus.
Do you think a little bit like when Facebook launched decades ago and within 10 years was public and a giant, partially due to some strategic purchases that we all thought, maybe not you, Ram, was overpriced Instagram? It was an incredible deal. And basically, Facebook for a lot of people is irrelevant now. Instagram is not. So that, looking back, man, that was brilliant. I
agree. I mean, the return on owning Meta, Facebook, has been extraordinary. I think there are other opportunities that will emerge too in the IPO markets.
So do you think that if we there's going to be a company now that within 10 years will be, well, let's be bold. I wasn't going to say top 20, top 10. Is it possible?
Yes. You're going to see turnover in the top 10 market cap names. Absolutely. Netflix is no longer part of the thing anymore. Netflix,
yes,
6% earnings growth. Apple has a sub 10% earnings growth and a PE now of 27%, PE of 27. They're a 2.7 trillion market cap company. Nike's having year-over-year sales decline. So this is Schumpeter's creative destruction. It's always at work. So there'll be new names.
Do you think one will be a biotech?
Biotech will get acquired by a big pharma company. That's the nature of how that works. Within biotech, you have Novo Nordisk, you have AstraZeneca, you have Eli Lilly, and they're growing dramatically because of these weight loss drugs like Ozempic. They're phenomenal, and you get third-party payer systems. So it's a pretty good business to be in. They're expensive. People know these things, right? So I think biotechnology stocks are a better way to play it, again, through that long-short hedge fund strategy, as I mentioned. ARM is interesting, not at current prices, though. ARM just recently had an IPO, SoftBank stock. To summarize ARM, I put it this way. ARM has intellectual property in every cell phone in the world. Every cell phone in the world. Wow. Manufactured in China or the US, doesn't matter. They don't charge enough for it. So remember like Qualcomm. Qualcomm in the 2000s was a go-go stock because they had CDMA technology, which they could license to the Motorola's and others of the world. And they did extraordinarily well. And they still license CDMA technology today. So the bull case on ARM is that ARM simply needs to raise prices because they have unique IP. And that's what they're doing. So SoftBank replaced the former CEO. They brought a new CEO. I like a business model that's simple and easy to understand. If the mission is raise prices, it's pretty easy to execute against that plan. Now, ARM it's an expensive multiple right now, though, right? So I'm hoping, I'm not forecasting, I'm hoping we have a Facebook-like outcome where it's misunderstood and the stock drops out of bed, and then hopefully I can pick some up. But I think in the semiconductor space, there's a lot of great opportunity there. I think that top 10 list, if you fast forward 10 years, will have a number of semiconductor names. What are the big themes we're talking about here? We're talking about electronification, talking about nuclear renaissance, talking about the rise of AI, robotics, driverless cars, autonomous technology. All of that requires semiconductors.
Okay, we'll put you on the spot a little bit.
Yeah.
Within 10 years, will Alphabet, aka Google, and Tesla still be top 10?
Not Tesla. I think Alphabet has real shot on goal to do that because they have a better relative value than the other big tech companies. And Alphabet has certain competitive advantages that others do not. Here's what they are. One, they own the relationship through the browser. Second, through search, which is under pressure. They have the Android platform. And their AI, which is not unleashed to the public. I don't mean Bard. Here I mean Lambda, which is their in-house private skunkworks AI, has human-like AI that's better than GPT. And the transformer, which was the basis for the LLM, the transformer refers to the white paper, the machine learning algorithm. That was developed at Google. So they were slow to get to bat, and for good reason. If Google were to introduce AI, it would undermine their search business, classic innovator's dilemma. But now their hand is being forced. It's a top level focus, and they've got founder engagement. So yeah, I believe Google is a compelling opportunity. Ruth Porat's the CFO. They've done a good job of lowering expectations. Ruth Porat's, of course, Morgan Stanley, formerly CFO there. So they know how to manage public market expectations.
Wow. I mean, it seems like our hour and 40 or so minutes just went by so quick. I hope the audience really enjoyed it. By the way, I'm not quite sure how. Maybe it's because Ram and I did kind of a quasi-joint stream, but it looks like for questions that you all may have had in comments, they were kind of disabled for some reason. So if you sent something in, like Angelo's not acknowledging me or asking the question, I promise it wasn't me. We'll try to figure out that glitch or issue for the next time. But I hope you really enjoyed today's discussion. I will have closing commentary, but before I do that, out of respect for our guest and perhaps his time limits, Ram, for those that want to follow you on Twitter, subscribe to any Substack or newsletter, or simply inquire about how they could have access and work with your organization in terms of advice or guidance relative to investing, how could they reach out?
So first off, thank you for the time, Angelo. I always love talking to you. You're an original thinker, and the scope and breadth of topics so interesting, and it's just a lot of fun. I really enjoy it. So thank you again. We have a newsletter. It's published every week. You can subscribe at lumida.com. That's one. I'm also on Twitter at Ahluwalia. We're also on at Lumida Wealth. We have YouTube Shorts. We're on TikTok too. So we're publishing more content there as well. And we are a outsourced family office for ultra high net worth individuals. We deliver endowment style investing. That means cross asset class investing, everything from distressed commercial real estate to long short biotech, together with trust, tax, and estate. So tax optimization, onshore, offshore tax planning, bring that together with a institutional grade CIO experience. So that's Lumida. It's been always a pleasure. Thank you again, Angelo.
Well, you're very kind. I'll give a wrap up by Angelo standards. I'll try to keep it relatively quick. One, it's always great to have Ram on. I've known him for many a year, back in the more pure single family office days, to attending programs I used to do in New York at the Westchester Country Club in Rye, and probably the Greenwich Country Club. So it's always been a pleasure to know him for 10 plus years. I hope you really enjoyed today's discussion. I know I generally prefer long form interviews. I know outside of Joe Rogan, they're not as trendy as they used to be. One day I'm going to have to learn with a team how to slice and dice and probably do more shorts. But this has been a great pleasure for me. And I appreciate Ram's nice words as well. I'm not saying I'm the nicest guy. I'm not saying that I'm the most educated. I'm not. But I do believe strongly that the community of single family offices and what's out there servicing them, it's just not good enough. It's not intellectual enough. It doesn't challenge boundaries. It's way too traditional. It's not even good from a historical perspective. It's definitely not revolutionary. And when you're a revolutionary, does that mean you're wrong? You betcha. And does that mean you'll make some mistakes? I've made them. And more to come, by the way. But I hope you enjoy the content that I put out. I like to give back a good amount to the community. Follow me on all social media platforms, Family Office TV and Family Office. So I have both on YouTube. I'm Angelo Robles on LinkedIn, and you could find my other platforms on Twitter and even Twitch. If you're 16 years old and may like some of my content and not bored by it, go to Twitch and follow me there. So it's been great fun. And again, a lot of the work that I do with families and even those that service families, for now, I keep it all housed under, very simply, my name, AngeloRobles.com. Again, that's AngeloRobles.com. My core work is providing deep education, really deep, through my masterclasses, which I own at Family Office Masterclass, and a private membership group that I have for a very intimate group of single family offices only, called SFO Continuity. So reaching out to me through the website and inquiring and getting true, deep resources with critical thinking, creative thinking, and access to amazing deep thinkers and special benefits. That's all through AngeloRobles.com. So inquire and learn more. But in the meantime, I hope you do enjoy my free content, the work that I'm doing in Family Office TV, and great guests like today that we had on with Ram. Ram, again, thank you so much. And audience, until next time, thank you. My pleasure. Bye-bye.